Mr. AG here, Asian guy. And before we get into the numbers tonight, I want you to understand something. What is happening right now across gold, silver, platinum, and palladium is not a simple market story. It is not just a rate cut story. It is not just an inflation story. It is not just a geopolitical story. It is all of those things colliding at the same time, in the same week, pointing toward the same moment. And that moment is now. This week has been one of the most data-dense, event-heavy, sentiment-shifting weeks we have seen for precious metals in a long time. And I'm going to walk you through every single piece of it tonight, connect every dot, give you both sides of the picture, and let you make your own decision. Because that is what we do here. No hype, no agenda, no product to sell you. Just the raw picture, clearly explained, so you can think for yourself. Let me start with where we are right now, because context matters enormously this week. Gold hit a record high of close to $5,600 per ounce at the end of January. Think about that number for a second. $5,600. That is a number that even the most bullish gold analysts were hesitant to put in their models just 18 months ago. Then February arrived and the picture changed fast. Gold slid into one of its largest price drops in decades, dipping as low as $4,400 as we moved into the first week of February. That is a $1,200 swing in a matter of days. Silver, which hit its own all-time high of over $121 per ounce on January 29th, has been hit even harder in percentage terms. Platinum reached 12-year highs in recent weeks. Palladium, which has been the difficult one in the precious metals family for a few years now, is still trying to find its footing. So when we talk about this past week being bumpy, that is not just a casual word choice. The volatility we have been tracking is real. It is data-driven, and it matters for anyone holding positions or considering entry points right now. Now, I want to be clear about something before we go any further into this analysis. I do not sell signals. I do not sell memberships. I do not sell mentorships. I do not sell anything. My channel is MRAG Asian Guy, and that is the only place you will find me on YouTube. If anyone is approaching you, claiming to be me, and offering you something for money, that is not me. Block them immediately and protect yourself. I share the data, I show you both sides of the picture, and I help you think through what is happening. That is it. That is the whole value proposition here. And based on the messages many of you have been sending, that approach is working because you are telling me you are seeing the market more clearly, understanding what the data actually means, and making better decisions because of it. That is the only thing I am here for. With that said, let us get into it. And I want to start with the macro picture because everything this week, every price move and every metal connects back to two things, the Federal Reserve and geopolitics. You cannot understand what gold did on Wednesday without understanding what the Fed said on Wednesday. You cannot understand what silver did on Thursday without understanding what the dollar did on Wednesday night. These things are connected, and I'm going to show you exactly how. The Federal Reserve released the minutes from its January meeting this week. And here is what those minutes told us. Policymakers were almost unanimously in favor of keeping rates unchanged at the January meeting. That part was expected. But the split in the room is where it gets interesting. Some officials signaled they would consider further rate hikes if inflation remains sticky. Read that again. Further rate hikes, not cuts. Hikes. That is a hawkish signal that markets did not fully price in. On the other side of that same room, other officials indicated a willingness to back additional cuts should price pressures ease. So you have the same group of people, the same Federal Open Market Committee, and they are essentially pointing in two different directions. One group is still worried about inflation coming back. Another group is ready to cut if the data cooperates. And what does that mean for precious metals? It means uncertainty. Now, right before those Fed minutes dropped, we got non-farm payroll data on February 12th. The U.S. labor market continues to display resilience. Payrolls beat expectations. A strong labor market data print does one very specific thing in the current environment. It reduces the urgency for the Federal Reserve to cut rates. And when rate cut expectations get pushed back, gold typically comes under pressure. Not because gold is weak fundamentally, but because the opportunity cost of holding gold, which pays no yield, becomes relatively higher when interest rates stay elevated. So on February 12th, you saw gold slide. You saw silver follow. The data was the driver. That is not manipulation. That is the macro mechanism working exactly as it historically has. But then something interesting happened on February 13th. The U.S. Consumer Price Index data was released, and it came in softer than expected. Inflation was cooler than the market anticipated, and just like that, the scales tipped back in the other direction. Suddenly, the case for a rate cut looked more viable again. Gold rebounded, silver steadied. The seesaw that I am describing for gold this week, oscillating between $4,900 and $5,040, is not random. It is the market repricing the probability of a rate cut in real time, back and forth, day by day, as each new data point lands. And the next major data point that everyone is now watching is the Personal Consumption Expenditures Report, the PCE. That is the Federal Reserve's preferred inflation gauge. That data lands on Friday, and it is going to matter. If PCE comes in soft, the door for a June rate cut, which is currently the most likely timing according to the CME FedWatch tool, stays open. If it comes in hot, that door gets pushed back further, and precious metals will feel it. By the way, I want to pause here and ask a quick question. Where in the world are you watching from right now? Drop your city or country in the comments below. I am always curious to see where this community is spread across the globe, and it genuinely helps me understand which markets and time zones matter most to the people watching this. Let me know. Drop it below. Now let us talk about gold specifically and what the price action this week is actually telling us. Gold hit an intraday low of $4,907.41 on the morning of February 12th. It lost the battle to hold the $5,000 mark in morning trading. That $5,000 level is not just a round number. It has become a psychological and technical support level that the market is watching extremely closely. When gold broke below it, you saw a wave of selling. When it recovered back above it on February 13th, trading between $5,000 and $5,040, you saw some stability return. But Monday, February 16th, and Tuesday, February 17th told a different story. Gold could not hold that level again, sliding below the 4,900 support line. Then Wednesday, February 18th, brought some relief with gold once again fighting its way back toward 5,000. What this price action tells me is that we are in a consolidation and repricing phase, not a trend reversal, and that distinction is critical. The difference between a trend reversal and a consolidation is enormous for how you position yourself. In a trend reversal, the underlying fundamental case has changed. Demand has collapsed. The macro backdrop has shifted against you. That is not what we are seeing here. In a consolidation, the market is digesting a massive move, pausing, repricing based on new information, and then deciding whether to continue the trend or not. The underlying fundamentals for gold right now remain firmly in place, and I want to be specific about what those fundamentals are so we are all looking at the same picture. Central bank reserve diversification continues at a structural level. This is not a short-term trade for central banks around the world. They are shifting away from dollar-centric assets over multi-year time frames, and gold is the primary beneficiary of that shift. Fiscal deficits in major economies are expanding, not contracting. Sovereign debt levels globally are at historic highs. These are conditions in which gold historically performs its role as a store of value most effectively. The dollar, while hovering near a more than 1 week peak this week, partly due to the strong labor data, has been in a broader weakening trend. It is down 12% over the past 12 months. A weaker dollar makes gold cheaper for international buyers, which supports demand. So when you look at this week's price action in gold, you are looking at short-term macro data points pushing and pulling a metal that has an extremely strong multi-year structural tailwind behind it. Corrections after parabolic advances are inevitable. That is just how markets work, but the broader bull trend based on these fundamentals remains intact. One more gold story worth noting this week. The 2026 TSX Venture 50 list was released on Wednesday, February 18th, with several gold companies recognized as top performers on Canada's Venture Exchange. The top 5 gold stocks on that list are 1911 Gold, TDG Gold, Omai Gold Mines, Prospector Metals, and Gold Group Mining. If you follow junior mining, this is worth paying attention to because the TSX Venture 50 recognition typically brings increased visibility and attention to these names. I am not recommending any of them. Do your own research. But the news flow is part of the broader picture this week. Now let us move to silver, because silver this week deserves its own deep analysis. The story in silver is more complex, more volatile, and frankly more interesting than gold right now. And if you have been watching this channel, you know I have been tracking the silver picture very closely. Here is the raw data from this week. Silver fell by more than 9% on February 12th, dropping from around $83 to $75 as it followed gold on the downtrend. That is a 9% single-day move, in a single day. February 13th, silver traded mostly sideways at the $77 level. Through Monday, February 17th, silver continued along this trend line, limping but not collapsing. Then on Wednesday, February 18th, silver started to gain ground, rising from the $75 level to an intraday high of $78.24 as of 11 in the morning Pacific time. Now here is where I need to separate the short-term noise from the structural story, because they are very different things in silver right now. Short-term, silver is under pressure. We know why. The dollar is strong, the Fed is uncertain, risk sentiment is mixed. These are the same macro forces hitting gold. But silver has an additional layer of complexity that gold does not have. Silver is not just a monetary metal, it is also a critical industrial metal. And right now, two of the most important industrial demand stories of the decade are converging on silver simultaneously. The first is artificial intelligence and data center infrastructure. Silver is the most electrically and thermally conductive metal on the planet. Those are not marketing words. That is a physical property that cannot be substituted around. As data centers scale up to handle the compute demands of AI models, the electrical infrastructure inside those facilities requires enormous amounts of silver. High-performance computing, the kind that runs large language models and AI inference at scale, generates massive amounts of heat. Thermal management systems that can actually handle that heat load increasingly rely on silver-based solutions. The Global X Artificial Intelligence and Technology ETF, ticker AIQ, slid from approximately $50.55 to $49.94 over the past week, reflecting broader weakness in the AI sector. When AI stocks pull back, silver feels some of that pressure because part of its current valuation includes a premium for AI demand. When the sector softens, that premium compresses slightly. The second structural story for silver is solar photovoltaic expansion. The Silver Institute, in its latest annual outlook published on February 10th, reported that it expects macroeconomic and geopolitical conditions to remain broadly supportive for silver in 2026. More importantly, the Institute forecasts a sixth consecutive annual structural deficit of around 67 million ounces for silver in 2026. A structural deficit means that demand exceeds supply for the sixth year in a row. Total supply is rising toward decade-high levels, but it is still not enough to fully meet the current surge in investment and industrial demand. That deficit does not disappear in a week of price pressure. It compounds. And every week that the physical silver market runs a structural deficit is another week that the long-term supply picture gets tighter. Now, I want to pause on something that is happening technically with silver that you need to understand. From a technical perspective, the latest rebound in silver has produced two lower highs. Let me explain what that means for people who are less familiar with technical analysis. A lower high is when price bounces off a low point, but fails to reach the previous high before pulling back again. When you get two consecutive lower highs, it signals that the buying conviction behind each bounce is getting weaker. Buyers are stepping in, but they are not strong enough to push price back to where it was before the last dip. That pattern tells you that the market is still digesting the massive volatility shock from the January highs and the early February correction. It does not mean the bull market is over, but it does mean that silver may need more time to consolidate and rebuild buying pressure before the next sustained move higher can materialize. And despite all of this short-term pressure, silver held above $77 on Thursday after climbing roughly 5% in the previous session. That 5% single-session recovery while the dollar was strengthening tells you something important. It tells you that the physical and structural demand underpinning silver is real enough to create buying pressure even in a macro environment that is not perfectly favorable. That is resilience. That is not a market that is fundamentally broken. So where does that leave us with silver? Structurally bullish, short-term volatile and digesting a massive move. The 67 million ounce annual deficit does not care about 1 week of price pressure. The AI demand story does not care about 1 week of AI sector weakness. The solar demand story does not care about Fed minutes. These are multi-year structural forces, and they point toward higher silver prices over a meaningful investment time horizon. The path there may be volatile. It almost certainly will be. But the destination, if the fundamentals play out, remains compelling. Before I move to platinum, I want to ask you something. Comment below right now. What is your current outlook on silver for the next 30 days? Are you bullish, bearish, or neutral? And from where are you watching this? Drop your location and your silver outlook in the comments. I read through them, and it helps shape what I cover in the next video. Now let us talk about platinum, because platinum has a story this week that I think is being undercovered relative to how significant it is. On February 12th, Platinum was trading as high as $2,136 per ounce in early morning trading before following the broader metals complex lower to an intraday low of $1,982.50. It bounced back above $2,070 the next day and has broadly managed to hold above the $2,000 level through this week. Wednesday, February 18th, brought a recovery to an intraday high of $2,122.90. Here's the bigger picture context. Platinum is one of the top performing metals over the past 12 months, reaching 12-year highs in recent weeks. When I say 12-year highs, I want you to sit with that for a moment. 12 years. This is not a metal that has been on a short-term momentum trade. This is a metal that has been building toward a structural revaluation over a long period of time, and that revaluation is now showing up in the price. What is driving platinum right now? Two primary forces, and they are both structural. The first is the hydrogen economy. Platinum is an essential catalyst in hydrogen fuel cells, both for production and for power generation applications. As governments and corporations around the world accelerate investment in hydrogen as a clean energy solution, the demand picture for platinum expands significantly. This is not a speculative story, it is an infrastructure story. Hydrogen fuel cell technology requires platinum, and there is no viable substitute at commercial scale right now. The second driver is automotive demand, which sounds counterintuitive in an era of electric vehicle growth, but bear with me. Platinum is used primarily in catalytic converters for gasoline and diesel combustion engines. While EV adoption has been growing, the pace of that adoption has been slower than many projections suggested a few years ago. Consumer confidence in EVs has been uneven. Charging infrastructure gaps persist in large markets. And the combustion engine vehicle fleet globally, particularly in emerging markets, is not going away as fast as some analysts projected. The result is that platinum demand from the auto sector remains robust, even as EVs take a larger share of new vehicle sales. You have a metal with two strong demand drivers, hydrogen and automotive. And what is happening on the supply side? Global platinum reserves remain critically low. South Africa, the world's biggest platinum producer by a significant margin, continues to face serious operational headwinds. Power shortages have been a persistent problem. The South African grid cannot reliably supply the electricity that mining and processing operations need to run at full capacity. Operational disruptions from labor, logistics, and infrastructure challenges have compounded the problem. The result is a supply side that structurally cannot keep pace with the demand picture. And this week, there was a partnership announcement that is worth paying attention to as a signal of where smart money is positioning in the platinum space. Johnson Matthey, Sibanye-Stillwater, and Valterra Platinum launched a multi-million-dollar partnership specifically focused on developing new platinum group metals applications in clean energy and industrial technologies beyond the automotive sector. Read that carefully. Beyond the automotive sector. These are three major industry players explicitly investing in the next phase of platinum demand growth. When companies at that scale commit capital to expanding the application base for a metal, that is a demand signal worth taking seriously. On February 12th, palladium followed the broader metals complex lower, dropping from $1,741 to as low as $1,664. It bounced back above $1,783 on Monday, February 17th, before volatility returned through Tuesday, trading in the $1,670 to $1,720 range. Wednesday brought an intraday high of $1,774 as of 11 in the morning Pacific time. So palladium is moving around, but it is still dramatically below its March 2022 all-time record of $3,440.76 per ounce. That is a significant distance from peak. And the question everyone in the palladium market is trying to answer is whether we are closer to a floor or whether there is more downside ahead. The bear case for palladium is relatively clear. The primary industrial use of palladium is in catalytic converters for gasoline-powered vehicles. As electric vehicles take more market share, the long-term demand trajectory for palladium in automotive applications faces structural headwinds. Additionally, analysts at Heraeus Precious Metals are predicting that the palladium market may move into a surplus in 2026 as secondary supply from recycling increases by approximately 10%. Recycled palladium from scrapped catalytic converters has been growing as a supply source, and if that trend accelerates, it creates additional downward pressure on price in an already oversupplied environment. But here is the development from this week that changes at least one part of the palladium picture. The U.S. Department of Commerce issued a preliminary statement of support for anti-dumping duties of approximately 133% on unwrought Russian palladium imports. 133%. That is not a small tariff. That is a near-prohibitive trade barrier on a major supply source. This action follows a petition from Sibanye-Stillwater, one of the world's largest palladium producers, over allegations that Russian metal has been sold in the U.S. market at less than fair value. A final decision in the case is expected by June of this year. Now, Russia is one of the largest palladium producers in the world. If 133% duties are confirmed and maintained, the supply picture for palladium in the U.S. market changes materially. Whether that is enough to offset the demand headwinds from EV adoption and the recycling supply increase is a separate question, and it is a question that the market will spend the next several months working through. The final decision in June is going to be a significant event for palladium price discovery. Mark that timeline. By the way, I want to check in again. For those of you who are new here, welcome. I want you to understand what this channel is and what it is not. I am Mr. AG Asian Guy. I do not sell you anything. No signals, no memberships, no group chats, no mentorships, nothing. If anyone is reaching out to you claiming to be me or claiming to be affiliated with this channel and asking for money or offering you a service, block them and report them. It is not me. I am only here on this channel, Mr. AG Asian Guy. That is the only place you will find me. Protect yourself. Always. 4 metals, 4 different stories, but connected by a common thread. The macro environment that is creating short-term volatility across all of them does not change the underlying structural supply and demand fundamentals that are driving multi-year trends. And that distinction between short-term macro noise and long-term structural reality is exactly what I am here to help you see clearly. Now let us talk about the geopolitical dimension of this week because it is significant and it is directly impacting precious metals price action. On one front, U.S.-Iran nuclear negotiations are reportedly making progress this week. Leaders involved on both sides have seemingly pumped the brakes on the conflict escalation rhetoric that was dominating headlines last week. When geopolitical tensions ease, safe haven demand for gold typically softens. Part of the gold pressure we saw midweek is attributable to this development. If the diplomatic progress holds and a deal framework emerges, that removes one of the geopolitical premium components from gold pricing. And then there is the Lunar New Year factor, which is an underappreciated driver of this week's price action. The Lunar New Year holiday runs from February 16th to February 23rd this year. Markets in mainland China, Hong Kong, Singapore, Taiwan, and South Korea are closed or operating at reduced capacity. This means the Asian participation that has been critical to the recent rally in precious metals, particularly from Chinese retail and institutional buyers, is essentially absent this week. Reduced trading volume amplifies price moves in both directions. Smaller orders can move price more because there are fewer counterparties in the market. Ole Hansen, head of commodity strategy at Saxo Bank, put it clearly. Gold, silver, and copper have started the Lunar New Year week under pressure, with much of Asia and crucially China closed. The subdued trading environment has amplified price moves while underscoring how heavily the recent rally relied on Asian participation. That observation about Asian participation is critical context. When Chinese markets reopen after the holiday, the question is whether that demand returns and at what price level buyers are willing to step back in. If gold is at 4,900 when Chinese markets fully reopen, and Chinese buyers view that as an attractive entry point relative to where they have been watching prices, the demand resumption could provide meaningful buying support. If Chinese buyers assess the macro landscape and decide to wait for lower prices, the pressure could persist. In the UAE, gold rates posted notable increases this week, even as broader pressure hit Western markets. 24-karat gold gained 4 UAE dirhams to 604 dirhams and 50 fils. 22-karat gained 3.5 dirhams to 559 dirhams and 75 fils. This is a reminder that precious metals demand is globally distributed, and the UAE market, which serves as a regional hub for gold trade across the Middle East and South Asia, was showing buying activity even during a week of broader weakness. The Asian opening is always the first signal for where global sentiment is heading into the Western trading day. When Shanghai and Tokyo and Hong Kong markets open, they are the first to price in overnight news, from geopolitical developments to currency moves to commodity supply disruptions. For silver specifically, the Shanghai premium relative to COMEX has been a significant data point. A large and persistent premium in Shanghai tells you that physical demand in the world's largest silver-consuming nation is running at a level that paper pricing in the West is not fully reflecting. Watching whether that premium persists, expands, or compresses in the coming days is one of the clearest real-time signals of physical versus paper market alignment. Let me give you the two scenarios clearly because I think both are genuinely possible, and I want you to think through both of them with clear eyes. Scenario 1, the bearish continuation. PCE comes in hot on Friday. Rate cut expectations for June get pushed back. The dollar strengthens further. Gold breaks decisively below 4,900, and the next support level at 4,700 comes into view. Silver, without the strong physical demand backdrop that was driving it in January, follows gold lower and tests the $70 to $72 range. The AI sector continues its weakness, compressing the industrial demand premium in silver further. Platinum gives back recent gains as the broad risk-off environment hits even the strongest fundamental stories. Palladium's surplus fears and EV demand headwinds dominate over the tariff supply news. Bitcoin and crypto markets, which have been moving broadly in correlation with risk assets, continue to struggle. The forced liquidation that started the February correction continues into a second wave before any real floor is established. This is the bearish scenario, and it is not far-fetched given the data we have seen this week. Scenario 2, the bullish recovery. PCE comes in soft or in line with expectations on Friday. The June rate cut probability solidifies. The dollar softens slightly. When Chinese markets reopen after Lunar New Year next week, buyers who have been sitting on the sidelines through the holiday period step back in at what they view as an attractive discount to January highs. Gold recaptures and holds $5,000. Silver, supported by the structural 67 million ounce annual deficit and the AI and solar demand stories, stabilizes above 77 and begins rebuilding momentum toward 85. The two lower highs pattern in silver breaks to the upside as new buying volume comes in post-holiday. Platinum continues to consolidate gains, and the new institutional partnership announcement from Johnson Matthey, Sibanye-Stillwater, and Valterra generates fresh analyst coverage that attracts new investment interest. The palladium tariff story on Russian imports gets more attention as the June decision timeline becomes a topic of discussion in commodity research circles. Safe haven flows from ongoing Ukraine, Russia, and Middle East tensions provide a floor for gold even if the Iran nuclear talks progress. This is the bullish scenario, and it too is not far-fetched given the same week of data. One of these realities is going to become clearer by the end of Friday when PCE drops and Asian markets begin their post-holiday return to full capacity, and that is why this week's data flow, specifically PCE Friday and the Asian market reopen, matters more than almost anything else you could be watching in the precious metals space right now. 3 key takeaways, and then I will let you go. Number 1, gold is fighting to hold $5,000, and the outcome of that battle in the next 5 to 7 trading days is going to be determined primarily by two things: the PCE inflation data on Friday and whether Chinese buying demand returns with conviction when Lunar New Year holiday trading ends. The structural fundamentals for gold, central bank buying, fiscal deficit expansion, dollar weakness trend remain firmly intact, but the short term is genuinely uncertain. And the data this week has been pulling in both directions. Watch PCE Friday. Watch the Asian Open daily. Those are your leading indicators. Number 2, silver's structural story, 6th consecutive annual deficit, AI infrastructure demand, solar photovoltaic demand, is as strong as it has been. But the technical picture is showing 2 lower highs after the January peak, which means the market needs more time to rebuild buying conviction before the next sustained move higher materializes. The 5% single session recovery midweek is a sign of resilience, not weakness. But silver investors need patience right now. The destination is compelling. The path there will be volatile. Number 3, platinum's 12-year highs are not an accident. They reflect genuine structural demand from the hydrogen economy and persistent supply-side constraints from South Africa. The new partnership between Johnson Matthey, Sibanye-Stillwater, and Valterra signals that major industry players are betting on the next phase of platinum demand growth beyond automotive. Palladium's Russian import tariff story, with a final decision expected in June, is the supply-side variable that could materially change the palladium picture in the second half of 2026. Mark that timeline and watch it. Do your own due diligence. Understand your risk. Be accountable for your own decisions. Know your time frame. Are you trading this on a daily chart, or are you investing on a multi-year thesis? Because the answer to that question changes everything about how you interpret what I just told you. And if you are new here and you are in these markets without a clear plan, please be careful. Volatile environments like this one can be extremely punishing for underprepared capital. Invest with logic. Use your brain. Do not follow anyone blindly, including me, Mr. AG out.